We spend like our entire lives optimizing,
Yeah.
finding the absolute fastest route on our GPS, squeezing just one more meeting into the calendar, or relying on perfectly timed next day delivery for basically everything. We treat efficiency as the ultimate goal, almost like a religion.
Yeah, and I mean, it makes sense on a micro level. Efficiency saves time, it shaves off costs, and for the last few decades, it's essentially been the undisputed engine of the modern global economy.
Right. But the downside to an ultra efficient, perfectly optimized system is what happens when it encounters a single massive point of failure. Suddenly, all that brilliant efficiency doesn't look so smart. It looks incredibly fragile.
A vulnerability that the entire world just experienced firsthand, actually.
Exactly. So today we're taking a deep dive into an event that completely inverted the global economy. And that is the February 2026 closure of the Strait of Hormuz. We're looking at a staggering geopolitical earthquake, really, caused by the military conflict between Iran and a U.S.-Israel coalition.
And we aren't here to just, recap the daily news cycle or the military movements. We are examining this through a highly specific analytical lens today.
Yeah, we've got a fascinating piece of source material driving our conversation. It's a paper from the Global Review by Fareed Novin, and it's titled Energy, Leverage, and Strategic Signaling. And our mission for this deep dive is to use game theory, specifically this concept of Bayesian signaling, to decode how this Middle Eastern crisis instantly transformed North American pipelines.
Right, from these toxic political battlegrounds into the most strategically valuable assets on the planet, literally overnight.
It's wild. The underlying math and incentives of global energy completely rewrote themselves in a matter of weeks.
They really did.
Now, just a quick heads up for you listening before we get fully into the weeds here. Novin's paper deals with the actual current players on the board. So we're going to be discussing U.S. Presidents Biden and Trump, Canadian Prime Minister Mark Carney, Conservative leader Pierre Poilievre, and Alberta Premier Danielle Smith.
Which is a lot of big political names.
Right, but we are not here to take any political sides today. Our goal is purely, impartially, to unpack the strategic and economic analysis laid out in the source document.
Exactly. We are focusing entirely on the strategy, the leverage, and how these figures operate within the constraints of game theory. Nothing else.
Right. So if we want to understand how this flips the global game board, we really need to understand the mechanics of the choke point itself. Set the scale of this for us. When the crisis hit on February 28, 2026, why was this disruption so uniquely catastrophic compared to, say, the oil shocks of the 1970s?
Well, the International Energy Agency actually categorized this as the largest supply disruption in the recorded history of the global oil market.
Wow. In history.
Yeah, and the contrast with the 1970s is crucial here. Those historical crises were engineered by cartels. They were deliberate, artificial restrictions of supply to manipulate market prices. You could negotiate your way out of them.
Because there were actual people pulling levers behind the scenes.
Exactly. But the 2026 crisis was entirely geographical and physical. Novin calls it a choke point concentration event.
Because the Strait of Hormuz is essentially just a bottleneck.
Right, it's barely 50 kilometers wide at its narrowest point. So when military conflict shut down that specific waterway, it physically trapped about 20% of all globally traded oil.
That is just a massive chunk of the global supply.
And it wasn't just oil. It also trapped a comparable massive share of the world's liquefied natural gas, or LNG.
Yeah, the hard data from the source is just sobering. I mean, crude flows plummeted from roughly 20 million barrels per day down to barely 2 million barrels per day in March.
A 10x drop.
Yeah.
Just gone.
Insane. And Brent crude peaked at over $126 a barrel, which the paper notes is the largest single monthly price increase in history. And like you said, it wasn't just crude oil either.
No, Qatar's massive Ras Laffan LNG facility was struck during the conflict, which instantly dropped global LNG supply by 20%.
And here in North America, the shockwave hit retail gas stations immediately. I mean, U.S. average prices spiked to $3.70 a gallon basically overnight.
Right, and people usually assume the global market has built-in redundancies for this sort of thing, but the bypass routes completely failed.
Wait, really? Why did they fail?
Well, the pipelines running through Saudi Arabia and the UAE either just lacked the physical capacity to handle that much diverted volume, or they actively came under drone attack themselves. The redundancy was a total illusion.
I picture the post-Cold War energy market like a hyper-optimized logistics empire. Imagine a company that realizes they can save billions of dollars by routing every single one of their delivery trucks over one specific ultra-cheap highway.
Right, it looks brilliant on the quarterly spreadsheet.
Exactly.
Yeah.
But the second a bridge collapses on that one highway, that efficiency becomes a fatal flaw. The trucks literally cannot move. So how did the rest of the world, the countries completely reliant on that one highway, react to this sudden realization?
We saw cascading systemic failures, particularly across Asia. Countries like India, Pakistan, Vietnam, and Bangladesh faced acute, immediate fuel shortages.
Oh, wow. So they couldn't even keep the lights on.
Exactly. Governments were forced into severe demand rationing and panic buying on the spot market. And the Persian Gulf states faced an even more existential threat, honestly.
How so?
They rely on ships moving through that strait for 80% of their caloric imports, so it was a rapid onset food supply emergency for them.
Oh, man. So the panic creates this fundamental shift in how buyers value the product. They realize they can't just hunt for the absolute cheapest oil on the open ocean anymore.
Right. They needed what Goldman Sachs analysts started calling secure barrels.
Okay, that concept changes everything. So a secure barrel isn't just about the chemical composition of the oil, it's about the geography of its delivery.
Exactly. It's oil delivered via geographically stable, land-based infrastructure. A secure barrel doesn't rely on navigating a vulnerable maritime choke point that could be shut down by a stray missile.
It's safe.
Yeah. So almost overnight, the global market placed a massive structural premium on security over pure cost efficiency.
Well, if physical security is the new global currency, North America suddenly looks like Fort Knox, right? We're looking at a situation where Canada, the US, and private capital are suddenly holding all the leverage, thrust into a very high-stakes negotiation.
They really are.
And the paper models this dynamic as a Bayesian signaling game. Can you break down how that framework applies here?
Sure. So at its core, game theory studies how rational actors make decisions when they don't have perfect information about each other's true intentions.
Like playing poker.
Exactly. And to bridge that gap, they rely on signals.
Yeah.
But you have to distinguish between cheap talk and costly signals.
Okay, what's the difference?
Cheap talk costs a politician or a country nothing to say. Because it's free, rational players heavily discount it. A costly signal, on the other hand, is an action that carries genuine financial, political, or strategic risk to fake.
Okay, let's apply that to the source material. Novin points to Canadian Prime Minister Mark Carney. In late April and early May 2026, Carney goes on the record with major press outlets stating that a new Alberta oil pipeline is more likely than not.
Right.
But I have to push back on the paper's premise here. I'm looking at Carney's statements, and to the average observer, that sounds like the exact definition of political cheap talk.
It doesn't like it, yeah.
Politicians make grand, vague promises about infrastructure constantly. Why would Washington or the market take that as a credible, costly signal?
Well, it's a costly signal because of the specific domestic political capital he is burning to say it. Carney's political survival relies heavily on voters in Quebec and British Columbia, which are regions with strong historical opposition to pipeline expansion.
Oh, I see. So promising a massive fossil fuel project and then failing to deliver would fracture his base.
Exactly. But more importantly, Washington isn't just listening to his words. The signal is credible because it's backed by undeniable physical reality.
You mean the Trans Mountain expansion, the TMX?
Right. The physical data makes the signal costly and real. Between November 2024 and November 2025, non-U.S. exports of Canadian crude surged by an astonishing 289%.
Wow. Almost 300%.
Yeah. And by April 2026, right as the Hormuz crisis is peaking, the TMX pipeline was essentially hitting full capacity. Simultaneously, Alberta Premier Danielle Smith is actively pushing for 3 brand-new West Coast export routes.
So Canada isn't just bluffing about having other options. They are physically loading the tankers and successfully sending the oil across the Pacific to Asia. They're proving they can diversify their customer base away from the United States.
Right, and when a player in a game observes new, concrete evidence and mathematically updates their previous assumptions to reflect that new reality, that is called Bayesian updating.
Ah, okay. That's where the name comes from.
Exactly. Washington observed Canada's costly signal, updated their internal models, and shifted their strategy.
And the U.S. response was incredibly aggressive, wasn't it? U.S. President Trump authorized the Bridger pipeline expansion via a presidential permit mere days after Carney made his public signals.
Yeah, and the velocity of that response is heavily informative in a game theory context.
Because it shows they aren't hazaring.
Right, when an actor responds that quickly, it indicates extremely high confidence in the opposing player's signal. It effectively proved that both Ottawa and Washington had recognized the new reality post-Hormuz and were actively coordinating to lock down continental energy security.
They both looked at the burning wreckage of the global maritime supply chain, looked at each other across the 49th parallel, and realized they had to move immediately.
Exactly.
But, permits and political signals are just paper at the end of the day. Physical pipelines require billions of dollars in private capital.
Right, it's a massive investment.
Given the brutal, decades-long history of candle pipelines, projects like Keystone XL dying a slow death under the Biden administration, why would sophisticated private investors risk their billions getting back into this sector? I mean, it seems like a terrible bet.
Well, it represents a total reversal of expected value.
Oh.
Institutional investors are constantly weighing the expected financial returns against the risks of political interference or cancellation. Before 2026, the risk of a pipeline spending a decade bogged down in courts or being canceled via executive order was incredibly high, while the returns were steady but unremarkable.
So the political risk denominator was simply too massive to justify the investment.
Exactly. The Hormuz shock inverted that equation completely. First, look at the potential returns. You have Brent crude sustaining prices over $90 a barrel. You have desperate Asian buyers offering massive security premiums just to guarantee delivery.
Because they just need the fuel, whatever the cost.
Right. The sheer volume of capital available dwarfs the historical political risks. Additionally, it isn't always about building a $10 billion greenfield mega project from scratch.
Yeah, the paper highlights optimization projects, which seem to offer an insane return on investment.
Hellman points to the use of drag-reducing agents on the TMX pipeline.
Which are what, exactly?
These are essentially chemical additives injected into the pipeline that reduce friction, allowing the oil to flow much faster.
Oh, that's clever.
Yeah, and for a relatively tiny capital expenditure, somewhere between 9 and 20 million Canadian dollars, they can add 90,000 barrels per day of capacity.
Wait, 90,000 barrels a day for just 20 million bucks? That's nothing in the energy world.
Exactly. The financial upside on those optimization projects is too immense for private equity to ignore.
But even with those returns, I keep coming back to the political risk. Let's play devil's advocate for a second. What happens if the U.S. administration flips back to the Democrats in the next cycle? Don't the investors just get burned all over again by a new president canceling the permits to satisfy an environmental base?
Well, Novin actually addresses this through a framework called conditional cancellation probability. He argues that the probability of a future Democratic administration canceling these specific pipelines is fundamentally lower now than it was during the Keystone XL era.
Really? Walk us through the mechanism of that. Why wouldn't a future administration just revert to the old playbook?
Because the macroeconomic and geopolitical context has entirely transformed. Under pre-2026 conditions, canceling a pipeline was a relatively low-cost political maneuver.
Right. It made certain voters happy without crashing the economy.
Right. It pleased a highly motivated environmental base without causing immediate catastrophic damage to the broader economy. But during a global energy crisis, the median voters' priorities shift violently.
Oh, because of the prices at the pump.
Exactly.
Yeah.
Voters become acutely sensitive to massive inflation. When gas prices are soaring and the pipeline is explicitly framed as a strategic national security necessity to counter global adversaries,
The political cost of cancellation becomes devastating.
it becomes political suicide. Canceling a pipeline that is actively suppressing domestic inflation and providing secure energy during a global crisis is a luxury no politician can afford.
I see. And private investors understand this shift. They know the political shield protecting their physical assets is exponentially stronger now.
It's exactly.
I was trying to map out the sequence the paper describes, and it reminds me of stepping out onto a frozen pond. The first person to take a step is taking on all the risk, but once they walk out and the ice holds, the next person feels safer.
And eventually, everyone is out skating.
Right. The paper calls this an information cascade.
It's a cascade of shifting confidence, really.
Yeah. It starts with Prime Minister Carney signaling he is genuinely serious. That is the first step on the ice. Then the U.S. immediately approves the Bridger expansion, proving Washington is serious. Then the TMX physically delivers the oil, proving the commercial viability. And finally, the market price jumps, offering that massive security premium.
Yep. Each single action removes a layer of perceived risk for the next institutional investor in line.
It creates a gold rush of capital because the entire market suddenly looks around and realizes the ice is solid.
It perfectly illustrates herd behavior in capital markets. But it's vital to recognize this herd is moving based on rational, observable data.
Which is key.
However, we do have to zoom out because none of these moves by Canada or the U.S. are happening in a vacuum. There's a massive forcing function hovering over this entire geopolitical game.
The ticking clock, July 1st, 2026. The CUSMA review.
Right, the Canada-United States-Mexico Agreement. And this isn't just a standard bureaucratic check-in. The paper highlights that this specific review date dictates the fundamental architecture of North American trade all the way through the year 2042.
Wow, so decades of policy are on the line. Let's dig into the mechanics of this negotiation, because the paper references an article by Barry Appleton detailing how Canada is playing a highly sophisticated mixed strategy.
Yeah, Appleton's work on this is fascinating.
He says Canada is relying on something called undeployed leverage. But if you're negotiating the biggest trade deal of the decade, how do you use leverage by not deploying it? It seems counterintuitive.
Well, it's all about what Canada is deliberately holding back. Historically, a core objective for the U.S. in these continental agreements is securing guaranteed proportional access to Canadian energy exports. Washington wants an ironclad guarantee that if a massive crisis hits, Canada won't just pivot and sell all its energy to the highest bidder in Asia.
Which makes sense for the U.S.
Right. But Canada is currently holding back on making that proportional guarantee by withholding that commitment while simultaneously using the TMX to prove they can successfully sell their oil to Asian markets.
Oh, I get it. They are essentially holding the energy security hostage. They make the U.S. sweat.
Exactly. It forces the U.S. to the negotiating table on other issues. Canada is using the withheld energy guarantee to extract vital trade concessions, specifically much-needed tariff relief for other Canadian industries.
Because if Canada just handed over the energy guarantee on day one out of goodwill, they would surrender their most powerful bargaining chip.
Yep, they'd have nothing left to trade.
But wait, Canada is navigating intense internal political pressure at the exact same time. The source mentions Conservative leader Pierre Poilievre publicly attacking Carney, accusing the Prime Minister of wasting an entire year deliberating on potential pipeline commitments.
Which is a very loud public criticism.
Right, and on the surface, you would think the leader of the opposition loudly criticizing the Prime Minister's speed would severely weaken Canada's negotiating stance with the Americans. Like, it shows they're disorganized or desperate.
Paradoxically, though, in a game-theoretic environment, that domestic right-wing pressure actually strengthens the left-wing Prime Minister's hand internationally.
That's wild. How does that actually work in practice?
We can look at this through the lens of Nash bargaining theory.
Okay, lay it on me.
In a negotiation, both sides are trying to claim the largest possible piece of a shared pie. Poilievre is aggressively framing the energy trade linkage as a concrete, immediate deliverable. This intense domestic pressure restricts Carney's internal political maneuvering room.
So Carney literally can't back down.
Right. It proves to the American negotiators that Carney genuinely has a ticking clock behind him. He cannot afford to walk away empty-handed or drag the negotiations out forever.
It shrinks the bargaining zone.
Exactly. Because the Americans know Carney is under immense domestic pressure to finalize a durable pipeline commitment before the CUSMA window closes, Washington is incentivized to offer the tariff relief Canada needs to secure the deal right now.
Because if they wait, the deal might fall apart entirely.
Right. The internal political attacks effectively align with the international strategic goals, which forces both countries to stop posturing.
The U.S. desperately needs the energy security because the Hormuz crisis exposed their vulnerability. Canada desperately needs the tariff relief to protect its broader economy. Both sides use the physical pipeline infrastructure as the ultimate bargaining chip, and that July 1st CUSMA deadline forces everyone to sign on the dotted line.
It really is a masterclass in mutually beneficial leverage.
It's incredible. If there is one massive mental pivot you need to make after unpacking this entire crisis, it is fundamentally changing how you view the physical pipes in the ground.
For an entire generation, we treated pipelines as commercial liabilities. They were environmental headaches, legal nightmares, and political wedge issues. But post-Hormuz, they're viewed as strategically indispensable national security systems.
The core calculus of global trade just flipped. The cost of inaction, the risk of your entire domestic economy grinding to a halt because a narrow maritime strait 7,000 miles away got blocked by a regional conflict. That risk now vastly outweighs the cost of political reversal.
It took a terrifying, real-world global crisis to prove that localized resilience is actually far more valuable than globalized efficiency.
Yeah. The market learned a multi-trillion-dollar lesson about single points of failure in real time.
It was a very expensive lesson.
Absolutely. Well, it leaves me with a final thought I want to put out there for you listening to Mulliver. The 2026 Hormuz crisis proved that optimizing a global supply chain solely for the cheapest transport created a catastrophic hidden vulnerability. We built a system so efficient it became brittle and it broke.
Yep.
If that is true for the global oil and LNG markets,
Huh.
what other critical global supply chains are currently operating under that exact same dangerous illusion of efficiency?
We really have to look at the other ultra-cheap highways.
Are we looking at global food imports? Are we looking at the rare earth minerals required for battery production? What about semiconductor manufacturing concentrated in a handful of facilities? Which perfectly optimized, hyper-efficient global highway is just sitting there right now, waiting for its own inevitable choke point shock.
Honestly, identifying the next choke point before it snacks shut is the definitive geopolitical challenge of the next decade.
Something to keep you up at night, for sure. Thanks for joining us on this deep dive.